Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Milan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, it's Jackson Milan, the Wealth Mentor, and we're here for another episode of the Financial Freedom Secrets Show. And I'm very excited about this episode because we haven't actually spoken about anything like this on the show before. And I know this is going to absolutely blow your mind because this is a very complicated space that I've seen countless wealth accumulators and business owners get incredibly wrong, and it has cost them dearly. And we're going to be talking all around tax planning, tax structures. And I've got the man who basically wrote the book, and I literally have his book up behind me, talking around how you actually get your head around tax planning and tax structures. So Ken Race, thanks for joining us, mate. How you doing?
Good, and thanks for that lovely introduction, Jackson.
Mate, it's my absolute pleasure. So for those who don't know you and all of your genius, Ken, do you want to give us a little bit of a story? Who are you? What do you do?
All right. I think, although it'll add a few seconds to the story, it's worth going back to the beginning. And I was just walking down the street one day and said, I would love to be involved in the stock exchange. So I went and knocked on their door and said, how can I be one of those guys down on the stock exchange floor writing on the boards? So next thing I know, I was offered a job. So, and then through that, I became a broker that actually bought and sold shares, a client advisor. So stocks and shares are in my blood, if you like. I then went and did a bit of studies. I got some accounting. I then worked for very large multinationals where I started off as a management accountant, but quickly grew into management, where I actually ran operations in Australia, overseas assignments, set up joint ventures literally all around the world. And that gave me the bug, and sort of retired from that job in my 40s and set up my own little, if you like, finance organization where I help people raise risk capital, equity funding. And then I got bought out and took my customary 2 years where you're not allowed to work in that area. So bought some property with those funds, met a couple of accountants, and then helped them grow their one site into 17 across Australia. So it's that business growth, it's setting it up right. And because I think I came into the space late in life, I was like the 2-year-old who kept saying, but why, but why, but why? So when someone said, but this is the way you do it, it was like, oh, hang on, but why? And therefore, I was able to create a lot of new services and products, worked a lot with the ATO to get sign off. And that then took me to the next chapter of my life because I really had that bug on business and property, where I was asked to join someone else, Michael Yardney, that some of your listeners may know. So we set up a business together where I brought together all the things that I knew were missing in people's life in relation to getting advice to help them get a more holistic view of the world and how the different bits operate and actually roll out a plan, implement it, and then, if you like, keep getting it updated. So that's where I currently am at Metropole Wealth Advisory, and that's really helping clients grow, protect, and pass on their wealth.
Amazing, mate! What a journey, and I'm sure there's lots more stories of crazy and wonderful things that you've seen over the years. But the interesting thing, Ken, is that there's a big difference between the big corporate land of obviously these multinationals who we all know they do everything they possibly can to never pay any bonuses to the tax man. And sometimes they bend the rules a little bit. Yep. And small business owners aspire to be in a position where they don't pay any bonuses to the ATO, but I've seen very few business owners get really good tax structuring advice. Why do you think that is, Ken? Why do you feel there's so many small business owners who are trying to build wealth who get their tax structures wrong?
Look, I think it's a function of two things. One is the benefits aren't sold, can I say, properly and showing the advantages to that business owner, and then they balk at costs. But I think more critically, it's an area that a lot of accountants and even lawyers don't actually understand a lot. And therefore, they're uncomfortable, particularly when it comes to trust structures, multi-layered trust structures. And therefore, they give you the simple, quick solution, which, can I say, in the majority of cases is not necessarily the most appropriate. And people either live with it or they pay a lot of money to restructure themselves over time. And that's why I spent so much time understanding trusts and actually creating trusts that work for business people, and introduced a couple of, can I say, new and significant things to the landscape that had been there for 80 years. Just for your listeners, trusts normally stop after 80 years. So you've bought a property, it's 80 years later, your child or grandchild has it, the trust has to stop. So what happens then? Potential capital gains tax, stamp duty, et cetera, or you pass on your business and everything in between. So I said, but why does it have to stop? And it took a long, long time to work out how to do that. And it was possible. And then I fought with the ATO to get them to sign off on it. They saw it as tax avoidance. You're just trying to save the tax in the future. And then I convinced them it wasn't. So little things like that is the business knowledge and understanding of what businesses do and what they need that says, although it's not tax driven, we want a structure that actually can evolve with us, last as long as we do, and actually create the best asset protection, estate planning. You've got to consider a lot of things when looking at your structure. Are you going to be in business by yourself? Are you going to be there with others? Exit strategy is very critical because there's different taxes that apply depending on the structure you set yourself up in. And the difference is 100% difference in tax. You literally will pay double the tax in the structures that most people are set up in than another structure that they should have considered. Your estate planning, how do I pass it on? How do I bring in new partners? How do I bring in my children? And you've got to answer all those questions. And while it may seem daunting, I think it's, can I say, if you treat it as part of a checklist with the person asking you those questions, and then you end up with the right answer for the right reasons. And I think that's one of the main reasons I think people end up, if you like, going down the cheap and nasty route, or can I say just the wrong route?
Yeah. Because these are confronting questions, right? And for many people, they don't know immediately the answers. So they're like, stuff it. I'll just do the easy way, but that they think it's easy up front. And then it's only when they find themselves in a predicament, typically, or a significant event that may have occurred, whether it be an exit of a partner or somebody looking to enter or a tax event, then they realize, I should have done it this way. And so in many cases, it's too late. So it's really important. So, mate, when you, I'm sure you look at so many different structures of business owners and wealth accumulators. What are the telltale signs where somebody is structured incorrectly? Where do you commonly see people get it wrong?
Look, when people go into business, it's typically not to fail. It's to succeed. And a large number do. And then all of a sudden, they get these cash flows. They make profits. And they're paying out tax, or they're retaining tax in the business, which then is an asset protection issue, or they don't know how to get the money out tax effectively to make an investment, in other businesses or in property or in shares or whatever. So we end up locking up money because we don't want to pay the normal 47 cents tax.
Sure.
So then there's opportunity costs. So the other big area is, as you mentioned, on an exit strategy. people finally say, I'm going to sell either to an existing partner, to someone out in the big wide world, and they get hit with very large tax bills that could have been significantly reduced had they been in a different structure. Or they want to minimize the overall family tax bill, and they're restricted to only distributing to one or two people. So they lose all the flexibility, all the potential advantages, because they've ring-roaded themselves into a structure that doesn't allow them to do many things. And what I say to a lot of clients is the Tax Act was actually written to disadvantage PAYG people.
Yes.
And the problem is most small businesses start treating themselves as a PAYG person and then lock themselves into this scenario without thinking, where am I going to take this business in 2, 3, 4, 5 years' time? Having the end in mind and setting yourself up for that. And that's the biggest problems I see with people. And then if they have to restructure, it's then, is it worth it? There's got to be a big dollar benefit with a very short payback period.
Sure. Makes sense. Makes a lot of sense. Now, mate, a lot of our listeners and people that we speak to, they've heard of this idea of trusts, and they know that wealthy people use trusts, but very few people really understand how a trust works. So in the context of Australia, because it is very different to the US and other parts of the world, the main trust that we look at is a family trust or a discretionary trust. So from your perspective, mate, how would you describe a family trust and the potential benefits of a family trust for a business owner or a wealth accumulator here in Australia?
I think we've got to understand the fundamental difference between, call it a trust, and a company.
Yes.
So a company, the rules, if you like, are dictated by the government, ACCC, ASIC. They create a standard format, if you like. A trust is only a set of words on how you want to manage the assets that are owned by the trust. So therefore, there is no standard set of words. So I think one of the first problems people face is they go and get something off the shelf that, can I say, is the one size fits all, which, for your business doesn't necessarily work. So they call it a family trust because in essence, it's called a discretionary trust. It gives you discretion on the distribution because the powers of discretion are so wide, you probably wouldn't enter that into a business relationship with a third party because you could miss out, so to speak.
Exactly.
So they tend to be in the family group, and hence its nickname is a family trust. And basically, that allows you to operate your business in the trust, and the income comes in, the expenses go out, and then you have flexibility in who you distribute the profits to. And that's one of the first areas that we've got to look at, because if it's only a set of words, who's going to sign the documents? Who's going to open up the bank account? So we have to introduce a company as a trustee. So that trustee signs everything, signs contracts, opens up the bank account, etc. But that trustee is only doing it on behalf of the trust. Think of it as a young child who can't sign anything, who has a guardian. The guardian signs for everything, but can't say, I own it, because then it's like theft. So everything is done in the trust for the benefit of the beneficiaries. So that's the first concept that people find very difficult to understand. Is it the company or is it the trust that's operating? It's the trust. The company's only there just to sign bits of paper.
Makes a lot of sense. Great. And what would be the main reasons where you see people setting up a discretionary trust or a family trust?
I think there's a number of reasons. They're looking for some asset protection. So if something goes wrong with the business, then they're not personally liable.
Ken? I've lost sound on your side, mate.
All right.
So we had a little bit of a tech mishap, but we're back. So we were chatting about the reasons why somebody would set up a family trust or a discretionary trust. What are the main reasons that somebody would do that, mate?
So I think they do that for a number of reasons. They're looking for a vehicle that will give them asset protection in case something goes wrong in the business, then their personal assets are not at risk. They're looking for managing tax better. They're looking for a more efficient way to pass money through into another investment, such as a property. They're looking at the potential to bring, can I say, close family members in. And then as part of an exit strategy, if they're going to sell, it's a good vehicle, if you like, to minimize that capital gains tax at the end. And then lastly, it's what happens when I die? Then at least it's a good estate planning tool. So it ticks all those boxes and allows you, if you like, on an annual basis, if you're making, particularly in cyclical businesses where you make maybe a lot of money this year, a bit less next year, you can actually corral part of this year's great profit at a low tax rate to then use next year. And so you're kicking the can down the road, so to speak. Or a lot of our clients are using it to help fund an investment in a residential property that might be negatively geared. So they buy that in a discretionary trust as well. And for a PAYG person, your losses are then quarantined. Whereas in a business, you can actually move money from one trust to another. So you're effectively getting the benefits of any tax on negative gearing by shifting money from a profitable trust to one with a loss. And then that property has flexibility. And one of the things we're doing a lot for clients now is they're looking at passing on their wealth to the next generation, but before they die. When you die, yes, you pass it on, no capital gains tax, no stamp duty. But more and more people are trying to help their children pre-death, but are trying to avoid those two big taxes.
Makes sense.
So if that investment property is in a discretionary trust, you change control of the trust to your children, you don't trigger capital gains tax, and you don't trigger stamp duties. So that way, you as the parent can actually see the enjoyment your kids get out of the wealth you've helped create. You don't have to wait until you pass away.
Makes so much sense. And it's interesting because when we speak to a lot of our clients, it's part of their plan. They're like, look, I don't know how my kids are ever going to afford to get into the property market. I'd love to buy property for them each. I'm sure you've heard it countless times, but I think they overlook the mechanics of how that physically works without a trust in play. That if they buy it in their own name, you just wouldn't transfer it because of the costs. Like property is the most highly taxed thing in this country. You just wouldn't transfer the ownership of that to another individual if you could avoid it. And this mechanism allows you to do so. And the interesting thing, mate, is that you mentioned before, which I'd really want to talk on here for a moment, because I think for many of our listeners, they may not have realized the significance of this, is that there is what I thought for many years, a set in stone limitation of a family trust that it runs for 80 years. And at 80 years, it vests. That means that it has to be distributed out to beneficiaries. That's a CGT event. That's also a stamp duty event. There's a substantial amount of costs. Like, how did you get around to this rule? What was the thought process in order to get this ruling to allow you to find a way to get a family trust to run in perpetuity?
When I got into the public accounting space, call it about 2006, I thought I better read my couple of trust deeds that had some properties in it. I'd just taken everybody's word for it, but I thought, now as an accountant, I better know what I've got. And I sort of identified this sting in the tail, if you like. And then I started asking why. And it came about by Australia had taken on the rules of the UK, and the UK had introduced that limitation as a way of death duties. So 400 odd years ago, when these things were sort of flourishing, the UK government said, "Oh, I'll never get taxes," and they said they were going to tax companies when the founders died, and therefore trusts. They lost the argument on companies. But then introduced it for trusts. And then when we took over their laws, we took on that. But we had one very smart Governor General in South Australia who said, "Bugger this! Why do I want this law?" He was a great person. He actually created Torrens title, which is the way people own land, and that system's used all over the world. So one of the things he said is, "I won't introduce that law." And everybody said, "But that only works if you live in South Australia, or if the asset is situated in South Australia." And then I started working with a lawyer, and every time they came up with a reason why you couldn't, I actually then found a way around that. And after 6 months, the "oh my" expression came out. It was possible. And just for your listeners, I was actually asked to go and talk at a New South Wales Law Council at one of their CPD days on how I did it. So it does work, and I got the ATO to do it. So it was just this methodical process of not necessarily taking no for an answer, kept on digging and asking why, until we found a solution. And then that then became, I think, a cornerstone for people who can actually get longevity out of owning their assets in a discretionary trust that was not there before.
Makes so much sense, mate. And this is how you create true generational wealth, guys, because that's the thing, that in generation to generation, assuming that there's values that exist in the next generation, if there's tax, how are they going to pay it? And that's where we try and preserve that asset.
Correct. And can I say there's another reason? There's the tax, but more and more people are concerned that their children will end up in a family breakdown, and then those assets will actually leak outside of the family to the in-laws. So the clever use of trusts and the way they're worded can actually help preserve those assets to stay in the bloodline. And I've got to be a bit careful when I use the word bloodline. Another lawyer has copyrighted it. So a lineage, so it stays within that lineage, which means an in-law is not part of that. So that actually gives you tax benefits when you're doing intergenerational wealth transfer, but also protects it from an in-law in a divorce situation. So as part of our thinking, it was this holistic approach that looks at all the different bits and pieces that can erode the wealth that you've spent so much time creating.
Ken, are there any other tax structures that you amazing? So, Ken, are there any other tax structures that you would consider as part of this group structuring and wealth creation
one of the things
strategy?
Normally, particularly with successful businesses, is they want to, if you like, even out their profits. Sometimes it's up, sometimes it's down. So the problem is, if a trust, one of the big disadvantages of a trust is you have to distribute 100% of its profits. And if you don't, it's taxed at the highest marginal tax rates. So that means people then get it, and then you're taxed at your tax rate. So for me, it's introducing this concept of, they call it a corporate beneficiary. Some of your viewers might hear it as a bucket company. So you distribute to that, you then pay your 25 cents tax until you need it. And then when you take it out, you pay any top-up tax. But that's where it gets really interesting. If you're trying to, can I use the word save money to buy an investment such as an investment property? You're trying to save up your deposit. You've had to pay your 47 cents tax. I ask clients, wouldn't you like to only pay 25 cents tax on the money you're putting aside for your deposit? So how would you like the tax man to effectively pay your deposit? And that's introducing a company to actually own the property. Now, I normally say when I'm on stage or in another public forum, never, ever, 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 ever buy a property in a company, because you lose a tax advantage of the 50% discount if you ever sell. But if it's a long-term asset that you're probably not going to sell, I'd rather keep that 22 cents in the dollar in my pocket today and actually help me accelerate my wealth creation by actually getting the tax man to effectively fund my deposit. And that's a very large number. I mean, for $100,000, you're saving $22,000. For $1 million profit, you're saving $220,000. That's your deposit on $1 million property. So the use of second trust, particularly if you've got a very complicated business, you might own your intellectual property in one entity. You might buy your stock in another and then shift it over on consignment. Because one of the disadvantages with the trust is, because you've paid no tax, how do you build up your inventory or your stock levels? You would have had to pay your own individual one. But if you distribute it to a company, you pay 25 cents and then you send it over on consignment to be sold. So you're still getting the benefits of a company, but now with much more flexibility, much better asset protection, and if you like, a much better stepping stone to use those hard-earned dollars to grow your other investments.
Makes sense, mate. This is great. So there's obviously a lot of complexity to this. Like, people can't just go out and do this for themselves. They need to get some advice. So, mate, if people listen to this podcast and they've liked what you've had to say, how can they potentially get in touch with you to have a conversation around helping them with getting these structures and these wealth accumulation vehicles sorted?
So if they go to the Metropole Wealth Advisory website, there's an icon they can hit. I'm trying to think of the right word. That actually takes them to an inquiry page. And from that inquiry page, we will then get in contact with them and we'll actually see whether we can help them, what service would better suit them. Our services don't suit everybody. So if that's the case, we would tell you or tell that person. If it does, then which one? And then start working with you if you choose to work with us. So we try and sell the benefits of what we would do by maybe highlighting, can I say, one or two of the things that you might have not done appropriately, correctly. So our service looks at what needs to be fixing, what needs to be avoided in the future, and how you can improve moving forward. So we start off with a conversation just to prove that we can help you. And then if you decide to go ahead, you then engage our services.
Perfect. Awesome. We'll include all the links in the show notes. This has been super valuable. And I think this gives people an insider's insight from a perspective of somebody who truly understands this, because I know so many accountants and solicitors who dabble in this space that truly have no idea what they're doing. And guys, you need to get this stuff sorted. Yes, it's an investment, but it will cost you far more in the long run if you don't get these asset structures set up properly from the get-go, or get ongoing advice around this. So I highly advocate that you reach out to Ken and the team. Ken, mate, I appreciate you making the time, and you've shared so much wisdom, and I look forward to catching up again soon.
My pleasure, Jackson.
Guys, this has been another episode of the Financial Freedom Secrets Show. Remember, a good idea in theory remains exactly that, just a good idea until you take action. So if you had some pearls of wisdom from today, make sure that you put it into place, and look forward to catching you on the next episode.